Could one accidental premium payment to your cash value life insurance policy completely wreck your plans for tax-free accumulated wealth? That's the claim when it comes to modified endowment contract discussions. But how exactly does one cause a life insurance policy to become a modified endowment contract? And if you do cause a policy to become a modified endowment contract, what happens next? Hi, I'm Brandon, founder of the Insurance Pro blog and licensed insurance agent. I've been dealing with cash value life insurance and modified endowment contracts for years. I've helped people avoid them in all sorts of circumstances, so if you own a policy you are desperately trying to keep from becoming a modified endowment contract, or you've done a bunch of research about a life insurance purchase and still this is a little unclear to you, I'm here today to help you figure out how to avoid turning your life insurance policy into a modified endowment contract, as well as what to do if you think you might have accidentally already done it. First, to understand where the Modified Endowment Contract, or MEC, comes from, we have to go back to the 1970s and the 1980s. This was a time of high interest rates and high federal income tax rates. With the top federal income tax bracket at 70%, a number of high-earning Americans were in search of an investment that would shield them from burdensome taxes. Life insurance long benefited from an array of very favorable tax treatments. But it wasn't until the industry innovated this nifty whiz-bang contraption called universal life insurance that intense interest among those in desperate search of a tax shelter took shape. Universal life insurance disrupted the life insurance industry by allowing policyholders to place an infinite amount of optional money into the policy. This meant you could buy a very low death benefit policy, pay hundreds of thousands or millions of dollars into it all at once, and enjoy the many tax-favorable features of life insurance cash value and death benefit. It didn't take long, though, for Congress to catch wind of this, and it acted pretty swiftly. First, by passing legislation that defined what was and what was not a life insurance contract, using limitations on premium payments as the primary mechanism to establish what could still qualify for life insurance status. But those efforts didn't fully slow down the appetite wealthier Americans had for using, some might even argue abusing, life insurance to hide wealth from tax liability. So, in 1988, the 100th Congress passed the Technical and Miscellaneous Revenue Act, also known as TAMRA, which established a new test for life insurance contracts, and if those life insurance policies failed this test moving forward, they would be reclassified as modified endowment contracts. The test, created by TAMRA, is known today as the 7-pay test. So called because it stipulated that in order to retain life insurance status, a policy could not receive premium payments in excess of what would be necessary to guarantee all contract features within a 7-year period. Put much more simply, premiums were capped at what would effectively be a 7-pay policy. And it's for this reason that a number of people mistakenly believe that the 7-pay test only applies for the first 7 years of the policy, and that all you need to do to avoid MEC trouble is ensure that you don't make a premium payment in excess of this 7-pay amount during the first 7 policy years. But that's unfortunately not the entirety of how the 7-pay test works. The framers of TAMRA and the MEC classification were a bit more strategic in their thinking. I would argue the correct way to think about the 7-pay test is that it's a 7-year period that restricts the amount of premium that can go into the policy, but the rules of the 7-pay test can apply retroactively. So if the death benefit of the policy is reduced during that 7-year period, and any of the premium payments that were made up to that point exceed the maximum amount under the newly reduced death benefit amount, the policy will also fail the 7-pay test and become a MEC. In addition, the legislation also established that the 7-year period resets anytime the policy undergoes a material change. Now, like a lot of tax law, there is vagary, and the term material change is not super well defined, but there are a few actions that represent well-established examples of a material change. They include death benefit increases and adding benefits, or riders, to a policy. If something like this takes place, then the 7-year clock resets. And functionally, a lot of cash value life insurance policies will reset that 7-year clock almost by automatic default due to certain policy features. The increase in death benefit through the use of dividends to purchase paid-up additions on a whole life insurance policy is one such example. So the ways in which a policy fails the 7-pay test and becomes a modified endowment contract are 1, paying a premium in excess of the 7-pay test allowable premium, or 2, lowering the death benefit to a point that it is below the allowable premium for any premiums paid during the current 7-year period. While the second way to violate the 7-pay test seems easily avoidable, there are some circumstances that force eventual MEC status that are difficult, if not impossible, to avoid. Using certain death benefit riders attached to a whole life or universal life policy that eventually expire or become too costly to maintain could cause a reduction in death benefit that violates the 7-pay test. I did another video on this topic about a year ago, and we'll link it in the show notes below. I've also had the unfortunate experience in assisting people who bought one of these style policies from other insurance agents who didn't understand this possibility. And these people unfortunately face less than ideal conditions or options as they try to rectify the situation. Well, this isn't super common. It is out there, and there are a few insurance companies in particular that are especially vulnerable to this reality. So if you violate the 7-pay test and now have a modified endowment contract, what happens to your life insurance policy? The big consequence is it loses many of the tax-favorable features regular life insurance policies have. Distributions switch from FIFO to LIFO. This means you cannot remove your non-taxable basis first, but you instead must withdraw any gain which is taxable. Also, loans no longer receive differentiation from withdrawals, so any access to cash, either withdrawals or loan, carries an income tax liability if there is gain in the policy. This also applies to any assignments of a modified endowment contract, meaning that you go out and you get a loan and you pledge the MEC as collateral for the loan. On top of all this, distributions of gain from a MEC carry the same penalty tax for early withdrawals that regular retirement accounts incur. So just like your IRA, for example, distributions prior to age 59 and a half carry an additional 10% early withdrawal penalty tax. And MEC classification is permanent, regardless of how much premium you pay to the policy after failing the 7-pay test. Additionally, any transfer via 1035 exchange will immediately classify the new life insurance policy as a MEC, even if the design of the new policy wouldn't normally create a modified endowment contract. The only way around this is to completely surrender the modified endowment contract and start over again with a new non-MEC policy. Given the consequences of violating the 7-pay test and having your life insurance policy reclassified as a modified endowment contract, it's understandable that most people have a number of concerns regarding this topic. It's a somewhat cryptic subject, and many people have a difficult time unraveling the exact steps that cause a problem. Even with the process explained already in this video, I'm sure many people would admit they still don't really understand the exact situation that would lead to a MEC reclassification. So here's the easiest way you can ascertain how close you are to violating the MEC test. When you buy a life insurance policy, you will need to sign a policy illustration. This document has several pages, but somewhere it should report the 7-pay test premium. Now, this goes by a few different names, so it might be called out as the 7-pay premium, the MEC premium, or the TAMRA premium, but they all mean the exact same thing. Here's an example from an illustration reporting the 7-pay test premium as $12,939.27. This means the policyholder cannot make a payment to the policy in excess of $12,939.27 in any 1 year. And if he does, the policy will fail the 7-pay test, and the life insurance policy will then become a modified endowment contract. So you can use this information from the illustration to ensure you aren't paying too much into the policy. But above this, a lot of people worry that they might inadvertently pay too much into the policy and create a MEC. They worry further that they might not realize this for some time and find out years later that they don't actually own a life insurance policy anymore, but instead they own a modified endowment contract. Can this actually happen? The good news is no, not really. First, understand that all insurance companies test in-force policies for 7-pay test compliance with every premium payment received. If a violation occurs, the company must notify the policyholder that a violation took place and that the policy will now have MEC classification. All insurance companies give the policyholder the option and time to reverse the payment and undo reclassification to a modified endowment contract. In fact, one good element of the legislation that established modified endowment contracts is a provision that affords a life insurance policy owner a timeline to reverse the action that caused MEC status. You have up to 60 days after the close of the policy year in which the violation took place. It's important to note that it's 60 days after the end of the policy year, not 60 days after the violation. I bring this up because the actual timeline to reverse could end up being much longer than 60 days. If violation occurred at the very beginning of the policy year, you'd have the entire remainder of the year plus 60 days to reverse the payment. But if violation occurred at the very end of the policy year, you'd have the 60 days to reverse the payment. But what do insurance companies actually do when a violation takes place? In all my years in the life insurance industry, I've had a few clients violate the MEC premium. Every time it was by accident, but it's not as if they didn't find out. The insurance company immediately notified them of the violation and gave them simple steps to follow to reverse the payment that caused the violation. And I can tell you 100% of the time, clients chose to take those very simple steps and reverse the payment. So the notion that you might accidentally overpay, violate the 7-pay test, and discover years later that you actually have a modified endowment contract is simply false. Also, if you buy a policy that will violate the 7-pay test at issuance, insurance companies require a signed acknowledgement to this effect. So if the policy you bought is a MEC from the outset, the insurance company will certainly not conceal this fact from you. But if you already have a modified endowment contract, should you just give up on the policy? Probably not. You do have some options you can employ to extract the most amount of value from the contract. First, if you have no gain, you can take a distribution from it. There won't be any taxable consequence to that. Also, keep in mind that the death benefit of a MEC remains income tax-free. It functions identically to the death benefit of a regular life insurance policy. Additionally, the MEC will continue to defer income taxes on cash value, so cash accumulation will function similarly to an annuity. But it's probably a really bad idea to take loans against a modified endowment contract. I say this because loan interest receives the same treatment as a distribution. So interest that accumulates and becomes part of the loan balance carries an income tax liability to you, but you'll never actually receive that money. So this has the serious potential to cause a tax headache that's far larger than you're likely to be planning for. You can also annuitize a MEC in the same way you can annuitize a life insurance policy. A lot of people don't realize that several life insurance companies will let you trade in your life insurance policy's cash value for income as if you were buying an income annuity. Alternatively, you can transfer the cash in a MEC via 1035 exchange to an annuity contract and receive the income benefits from the annuity. You can use the exclusion ratio since the 1035 exchange will carry your cost basis over to the new annuity contract. And this will reduce the tax liability you face on your income.